We've got the fourth quarter GDP numbers and also the annual, the financial year GDP numbers, which will be put out on Thursday, just 2 days from now. What is the market expecting? We've got Shubhra Rao, who's chief economist at Yes Bank. Shubhra, there is a view that fourth quarter number could possibly come in even lower than 6%. What's the Yes Bank view?
We are slightly at a stable of Q3, which is 6.1. So we are at a 6.2 for Q4. Quite clearly, the drag has been industrial growth, and with a risk of a further downward revision in the February numbers, we have seen significant revision in the January numbers also. So clearly, the risks are that it could well come below 6.2. At this point in time, we are going ahead with 6.2, which takes the annual GDP to about 6.7. The drag sectors particularly have been mining and manufacturing. Our key risk is, on services. We have been generally, as an economy, very sanguine on services growth. But our sense is that with 2 or 3 quarters of very lackadaisical kind of a growth trajectory on industry front, it's bound to have an impact on the services sector performance also. As we saw in the preceding quarter, we saw a growth slip by below 9% at 8.7 in the third quarter, which also runs the risk going into the next 2 or 3 quarters, because it has a lagged impact of at least a quarter of the manufacturing sector's lower performance on the services sector. So as such, FY13 also, we see some risks on taking services sector growth for granted. And that is the reason, a lot of forecasts of 7% plus are now being revised lower. We haven't yet officially put it on print yet, but we have worked out internally. Clearly, we see GDP somewhere between 6.5% to 7% going into FY13 closing in also.
So you're saying that if we do see 6.7% in FY12, FY13 is more like 6.5, at best 7.
At best 7, that's right. Quite clearly, the risks, are emanating both from global uncertainties, but more importantly, I think it's the first 2 quarters of this current fiscal year, FY13, where we see growth remaining sideways, with some downside risks, because what happens to Greece on 17 June will have its impact on some of the growth levers domestically speaking also. So quite clearly, the risks that we ride are many at this point in time. The domestic policy in action, while we have seen some token action on petrol pricing, I think the risks still remain fairly large in terms of the other segments of subsidies, which actually matter. Petrol, in fact, on budget doesn't even carry subsidy because it's deregulated. So it's going to be the largest subsidy issue which will prevail, and we need to therefore completely focus on containing fisc, containing the current account, which remain the key challenges for India into the entire year of FY13. So I think we need a push for some bit of investment. What we are looking at is some improvement, very, very marginal, in the investment story, and that also would be probably based on the government's expenditure on capital projects, bringing in the crowding in impact for some of the infrastructure sectors for private sector space. So I think very, very minuscule, tepid investment recovery is what we see going into the second half of the fiscal year. But if I were to put the one broad picture on canvas for fiscal 13, I think cautious optimism, more of caution, a little less of optimism.
Just one last word, Shubhra, can't ignore the depreciating rupee, but you have Moody's who's saying that the sharp depreciation will also help correct some of the macroeconomic imbalances. Would you agree? Well, unfortunately, we have seen sticky components of imports, which remain relatively inelastic to, prices. So we have seen oil, we have seen gold, both these constituting almost 40% to 45% of total imports. Now, it's not that economy is completely collapsing, so we do not expect oil demand to correct very significantly. Gold has been a hedge to inflation, has been a store of value for various reasons, and the cultural appetite for gold. I don't think we can look at, gold imports very dramatically correcting. So if these two remain relatively inelastic, the pressure on trade deficit would still persist. And to my mind, yes, to an extent, the petroleum price revision
could have brought in some natural pruning of demand, which unfortunately at this juncture we are not seeing. So my sense is trade deficit, current account deficit would still remain between 3.5% to 4% in fiscal 13. I'm not too sanguine on external sector either.